In the ever-evolving landscape of central banking and economic policy, a delicate balance has emerged between managing inflationary pressures and nurturing a fragile recovery. At the heart of this intricate dance lies the Bank of England, navigating the intricate web of domestic and global economic forces with a deft touch. For months, the Bank of England and financial markets have been engaged in a tug-of-war, with the latter holding sway over the direction of interest rates. The powerful undertow of the U.S. Federal Reserve's monetary policy has shaped expectations more forcefully than the UK central bank's own words. Yet, a shift in this dynamic is now afoot, as the two forces find themselves falling into an uneasy alignment. Governor Andrew Bailey's recent remarks have left investors betting on an even chance of the first interest rate cut since the pandemic, arriving as early as June, with near certainty in August. This marks a significant departure from recent weeks, when investors ratcheted back bets on rapid cuts for the UK, swayed by stubbornly high inflation in the United States. It is a victory for Bailey, who has persistently pointed out that the UK economy is tracking more closely with the Eurozone, where rate cuts are due next month, than with the US. The door is wide open for a cut at the next meeting if inflation and wage pressures evolve favorably over the coming weeks, remarked Henry Cook, senior economist at MUFG MEA. There will be extra market scrutiny on the upcoming CPI and wage releases. For Chancellor of the Exchequer Jeremy Hunt, getting the markets in sync with the Bank of England is crucial. Hunt is betting on lower rates to deliver a much-needed political boost for the Conservative Party as the country heads into an election before the year's end. The Chancellor has made the bold claim that rate cuts would usher in a feel-good factor, a sentiment the government desperately needs after last week's rout in local elections. Bailey's deft maneuvering has now redirected investors' focus towards UK economic data as the guiding light for rate expectations. With two sets of inflation and labour market releases due before the next policy vote on June 20, the fate of interest rates hinges on how the UK economy evolves in the coming weeks. The Bank of England's journey to regain control of the market's rate path has been a winding one, marked by the powerful gravitational pull of the US economy. At the start of 2024, the Bank of England remained hawkish, driven by what appeared to be sticky underlying inflation, with 3 members of the 9-strong Monetary Policy Committee voting for rate hikes. Despite this, expectations of easing in the US imported into the UK market curve a steep series of cuts, 4 in total over 2024 and a further drop to 3.25% in 2026. In February, the Bank of England leaned into this narrative by endorsing the market's projected path in its forecast, helping to pivot towards a more dovish tone, with Bailey ruling out further hikes. By March, the final 2 hawks had abandoned their call for higher rates, with Deputy Governor Dave Ramsden joining Swati Dhingra in seeking an immediate easing, the clearest sign yet that the Bank of England, which was in tightening mode just 4 months ago, is now firmly planning to loosen policy. During this period, however, the US has drifted away from the UK's trajectory. Higher-than-expected US inflation data reversed the Federal Reserve's narrative, leaving Chair Jerome Powell warning that rates may remain elevated there for longer than anticipated. The Bank of England remains on course to ease in June following its May decision, remarked an analyst. Another dissenting vote for a cut, a guidance tweak emphasizing the near-term data flow, and a forecast that pushes back on market pricing all suggest the central bank is increasingly confident it can loosen policy soon. We think it will have the evidence needed to cut by its next meeting. In recent weeks, UK markets have followed the US lead, betting on fewer cuts from the Bank of England. This triggered an intervention from Bailey in Washington last month, where he noted that the factors driving the UK and US economies are sharply different. His remarks on Thursday completed Bailey's pivot, underscoring the divergent inflation dynamics between the two nations. It's certainly true when our staff do the analysis that market movements of late, in recent months, have been dominated by movements in the US coming over to other markets including our own, Bailey told a press conference. To my mind, the inflation dynamics in the UK are different from the US. It's important to make that distinction. We've seen some response in markets to that of late, where there has been some decoupling. But it is a question that we have to keep posing. The pull of the US economy is more than just a market dynamic, it has real-world implications for Britain. Mortgage and other borrowing costs are determined by market rates, which is why some home loan deals have been getting more expensive recently, despite the Bank of England's dovish shift. Bailey made another rare intervention in markets on Thursday, stating that policy needed to be less restrictive, possibly more so than currently priced into market rates. He later told Bloomberg TV that there was a high bar to making such statements, implying that more than the 2 cuts forecast for this year before the decision might be needed, or that, in the longer term, rates need to drop below the currently projected 3.75%. The scale and timing of rate cuts are of paramount importance for Prime Minister Rishi Sunak's government, which is due to call an election later this year. The Bank of England has upgraded growth forecasts for 2024, 2025, and 2026 and now expects a substantial increase this year in real household disposable incomes, a measure of living standards. This could well deliver the feel-good factor Hunt wishes for. Wages are expected to rise more strongly than previously thought in 2024 as inflation returns to the 2% target, giving the average household a 3% increase in real terms pay. Consumption growth will pick up as people feel richer due to falling energy bills in April. There is even evidence of improved sentiment in the housing market, with prices also expected to pick up in the months ahead. Hunt's tax cuts have received the Bank of England's seal of approval, with the central bank stating that they add 0.25% to the level of GDP. Whether the Bank of England delivers the June rate cut that Hunt, and the rest of the country, desires now hinges on how the data evolves in the coming weeks. There's a delicate balance to be struck between managing inflationary pressures and not snuffing out a nascent recovery, cautioned Anna Leach, deputy chief economist at the CBI, Britain's biggest business lobby group. The first rate cut is most likely to be in August. As the global economic winds shift, the Bank of England finds itself navigating treacherous waters, attempting to steer a course that reins in inflation while nurturing the fragile shoots of recovery. It is a delicate balance, one that requires deft maneuvering and a keen eye on the ever-changing economic landscape. The fate of Britain's economic fortunes rests on the bank's ability to read the currents and adjust its sails accordingly, charting a steady path through the tempestuous seas of global finance.